Welcome back to Asset Management Regulatory Overview. Again, this is week 5, and we are discussing ERISA and fiduciary responsibilities as well as other Department of Labor rules and regulations. And this is part 2 of a discussion on ERISA and financial fiduciary responsibilities, which overall all of this is financial, but this is fiduciary specific as far as the responsibilities. And our learning outcomes will be to understand the ERISA fiduciary's plan investment management function, as well as to understand non-investment related plan management and administration. As you recall in the first part of this discussion on ERISA and fiduciary responsibilities, we discussed, again, the definition of an ERISA fiduciary and the standards of conduct, duty to diversify, the duty of loyalty, as well as the duty of prudence. So now we're going to get into a discussion of fiduciary functions and application of ERISA standards. We're going to focus, as you can see from our learning outcomes, on the plan investment management function, as well as the non-investment related plan management and administration function. So let's start with plan investment management. So before we go too far into plan investment management as a topic, I'd like to reiterate that what flows from the basic definition of a fiduciary and the standards of conduct that are applicable to ERISA fiduciaries is that fiduciary functions are divided into 2 broad categories. Those categories are plan asset investment management and non-investment related plan management, which is generally plan administration. So these 2 general functions encompass a wide variety of activities, each of which may have its own set of considerations and issues. And we're going to discuss several of the most important activities that a fiduciary is responsible for in these categories and how to ensure that they're carried out in accordance with ERISA's requirements. So if we start with plan investment management, we'll see that an ERISA fiduciary's investment management function includes selecting the investment vehicles in which plan assets will be invested and designating the allocation of plan assets among the various investments. Of all the functions that a plan fiduciary undertakes, plan investment management is most likely the one that gets the most attention. And that's because proper investment management is critical for a plan to have sufficient assets to fund the benefits that participants are expecting and are planning for their retirement. If there isn't proper investment management, that's not good asset management. A failure to properly manage plan assets can lead to unjustified investment losses and insufficient investment returns. An ERISA fiduciary's investment management function includes selecting the investment vehicles in which plan assets will be invested and designating the allocation of plan assets among the various investments. And in the case of a plan in which participants are permitted to direct the investment of their individual accounts, this function means selecting the investment options that will be available for participants to choose from. The 3 fiduciary duties that we've discussed, the duty of loyalty, prudence, and the duty to diversify, all apply to the investment management function. The duty of loyalty dictates that decisions relating to the investment of plan assets must be made free of conflicts of interest. So, for example, a fiduciary investing plan assets in companies that the fiduciary has a substantial ownership interest in, or hiring a relative as an investment advisor would generally be a breach of this duty. The duties of prudence and the duty to diversify require prudent selection of plan investments that are adequately diversified, and or the selection of service providers to assist with this function. Of all these duties, the prudence requirement gets the most attention because fiduciaries can never be sure at the outset that an investment decision will be a good one. And without the benefit of hindsight, the best insurance against potential liability for investment decisions that turn out poorly is to be able to demonstrate procedural prudence in making those decisions in the first place. So let's discuss the importance of procedural prudence. DOL regulations provide that when making investment decisions, the duty of prudence requires the fiduciary to give appropriate consideration to the facts and circumstances that the fiduciary knows or should know are relevant to a particular investment or investment strategy, including the role that the investment or strategy will play in the plan's portfolio, and the fiduciary must act in accordance with the conclusions that were reached after that appropriate consideration has been undertaken. Consideration of facts and circumstances that the fiduciary should know about means that it is insufficient to consider only readily available information about the merits of the investment if additional information can be found through investigation and due diligence. Appropriate consideration includes a determination by the fiduciary that a particular investment or investment strategy is reasonably designed to further the purposes of the plan, taking into consideration the risk of loss and the opportunity for gain associated with the investment. Consideration should also be given to the diversification of the overall investment portfolio, the liquidity of the investment relative to the liquidity needs of the plan, and the projected investment return in relation to the objectives of the plan. If the fiduciary can demonstrate that a decision-making process was followed that incorporated those considerations, most courts of law would find that the decision was prudent even if the investment turns out to have performed poorly. So as you can see, investment returns can be bad or poor. It's all a matter of the investment making decision process. In one case, the court actually said that the test of prudence is one of conduct, not the performance of the investment. The focus of the inquiry is how the fiduciary acted in his selection of the investment and not whether his investment succeeded or failed. So this is an illustration of a court's application of the procedural prudence concept. In other words, the decision-making process is more important than the outcome. And if the fiduciary engages in procedurally prudent process, the investment decision will generally be respected no matter the actual investment outcome. More recently, courts have also weighed in on the prudence requirement applicable to 401k plan fiduciaries when selecting investment options to make available to participants. At issue in these cases is not just investment performance of the fund options, but also whether the fees associated with the fund are excessive, and of course, two issues are related since fund level fees can reduce potential investment return. Generally, the courts have held that prudence analysis is the same. That is, the focus has been whether the process for selecting investment options was prudent, not on the performance of the fund selected or the level of fees charged. In one particular case, the court actually held that even though some of the funds available in the 401k plan underperformed their benchmarks, because the plan fiduciaries regularly reviewed the performance of the funds and considered alternatives, they did not breach their fiduciary duties in the selection of funds for the plan, because the test of prudence is one of conduct and not performance, and it is easy to opine in retrospect that the plan's managers should have made different decisions. But 2020 hindsight musings were not sufficient to maintain a cause of action alleging a breach of fiduciary duty. Similarly, in another case, the court held that because the plan fiduciary's process for selecting investment options gave appropriate consideration to the fees and expenses charged by the mutual fund managers, the participants' claims that the selection of those investment options was imprudent failed. It's important to note that some courts have attempted to distinguish between procedural and substantive prudence. Substantive prudence looks at the results of the decision-making process in addition to the process itself. In one particular court case, the court indicated that a fiduciary's investment option selection process could be found deficient if the fiduciary could have selected equivalent funds that were less expensive. In contrast to traditional procedural prudence analysis, this focuses on the results of the fund selection process, meaning how the funds were actually selected, rather than limiting the evaluation to the appropriateness of the process itself. And as a practical matter, engaging in a procedurally prudent process is the best defense against potential challenges to fiduciary decision-making because it is much more likely that such a process will yield a substantively prudent result. So how does a fiduciary implement a procedurally prudent process for making investment decisions? One of the best ways to do this is to create a written process for making these decisions and then documenting that process was followed. That means adopting an investment policy statement. In the context of investment decisions, the way to do this is by adopting said investment policy statement. And an investment policy statement is essentially a set of guidelines for fiduciaries to follow when making investment decisions, such as investment objectives and strategy, growth, capital preservation, and how to balance things. Additionally, things that should be looked at are target asset allocation mix, performance benchmarks, fees, expenses, and liquidity targets. In the case of a plan in which participants direct the investment of their individual accounts, the investment policy statement would include such items as the types of funds that should be included in the investment fund lineup, the minimum criteria for fund option inclusion, performance benchmarks for each fund option, and the process for evaluating and replacing existing fund options if necessary. Having an investment policy statement and documenting that it was followed in making investment decisions not only provides legal protection to fiduciaries in the event a decision is challenged, but it also increases the likelihood that sound investment decisions will be made, thereby reducing the chance of challenges in the first place. Another important way fiduciaries can ensure prudent investment decisions is to seek the assistance of experts by hiring outside service providers. Because proper investment management requires a high level of specialized expertise that employers and other fiduciaries don't usually have, the prudent expert requirement effectively mandates that most planned fiduciaries obtain the advice of outside experts or delegate this function to outside experts rather than doing it on their own. And as with the hiring of any plan service provider, hiring an outside investment expert is in itself a fiduciary function, subject to ERISA's duties of loyalty and prudence. In the case of the duty of loyalty, this means ensuring that the outside experts are free of conflicts of interest. For example, the expert should either be independent of the investment product providers for the plan, or the compensation arrangement should be structured so the expert's advice or management function cannot affect the amount of it and its affiliate compensation. Additionally, the fiduciary must pay only reasonable expenses from the plan. Therefore, to the extent that an investment service provider's fees will be paid from plan assets, the fiduciary must carefully evaluate them to determine that they are reasonable. And this generally involves comparing the fee estimates of multiple potential service providers and understanding what providers are included in those fee estimates. As with the making of investment decisions, the duty of prudence requires the fiduciary to obtain and evaluate relevant information about potential service providers and act accordingly. Relevant factors to consider may include items such as professional qualifications and experience, fee structure, business practices, affiliations, financial condition, and liability insurance coverage. It also means ensuring that the service arrangement terms are reasonable. For example, ERISA generally requires that service agreements be terminable on short notice and without penalty. In addition, the service provider will want to ensure that the fiduciary and the service provider have the same understanding of the scope of services to be provided. To ensure these issues are adequately covered and to provide a record of the arrangement, agreements should be in writing. Once a provider is selected, the duty of prudence also requires monitoring the service provider's performance, reading the reports they provide, reviewing actual fees charged, periodic review of policies and practices, and following up on problems that come to the fiduciary's attention. To ensure that all appropriate due diligence is performed and all relevant factors are considered, the fiduciary should establish a written process for service provider selection and monitoring, similar to the investment policy statement for investment decisions, and document that this process was followed for each service provider retained. So if the decision is ever challenged, the fiduciary will much more likely prevail if it is able to point to the process and a record that the process is followed. Additionally, such a process helps ensure that the same criteria are applied in evaluating similar service providers so that the fiduciary can properly compare them. Another thing that we'll look at will be investment service provider hiring considerations. In addition to the general fiduciary considerations that we've already discussed, there are other important factors when making outside investment expert hiring decisions. Regarding investment advice or investment management, a plan fiduciary seeking investment expertise can obtain essentially two levels of service, and if the plan fiduciary retains the investment management duty but seeks expert advice, the investment advisor will not manage. The investment advisor will not manage plan assets, but rather simply provide advice, which the fiduciary may or may not follow in performing the separate management role. Alternatively, the fiduciary might delegate the entire investment management function out to an expert, in which case the investment manager would have actual authority to direct investment transactions. If the fiduciary delegates this function to an investment manager, who is an investment advisor registered under the Investment Advisors Act of 1940, a bank or an insurance company, and I wanted to let that ring. We can finish up our discussion. So let's take a step back. We're talking about investment advice and investment management. So as I mentioned, alternatively, the fiduciary might delegate the entire investment management function out to an expert, in which case the investment manager would have actual authority to direct investment transactions. And if the fiduciary delegates this function to an investment manager who is an investment advisor registered under the Investment Advisors Act of 1940, a bank or an insurance company, and acknowledges in writing that it is an ERISA fiduciary with respect to the plan, which is also called an ERISA Section 338 investment manager, the fiduciary generally will not be liable for the investment decisions of the investment manager. However, the appointing fiduciary will remain responsible for the proper selection of the investment manager and for monitoring the manager's performance to determine whether its continued engagement by the plan is appropriate. One circumstance in which a fiduciary might want to hire an investment manager is if the plan has an automatic enrollment feature or otherwise has a need for a default investment option for participants who fail to give affirmative investment directions with respect to their individual accounts. Under ERISA, a fiduciary, or should I say, under ERISA, a fiduciary generally will not be responsible for losses that result from investment in a qualified default investment alternative, provided the participant was first given the opportunity to direct the investment of the account and failed to do so. So, if they fail to do so and certain other requirements are met, this QDIA, also known as a Qualified Default Investment Alternative, must generally be managed by either an ERISA Section 338 investment manager or a registered investment company, for example, a mutual fund. Therefore, if the plan fiduciary wants to use an investment option other than a registered mutual fund as the plan's QDIA, an investment manager is generally necessary. Second, we'd want to know, are the services for the plan or participants? Which is actually an excellent question. Get to that one moment. I want to make sure I'm covering all of our topics here. So are the services for the plan or participants? If the plan is one in which participants direct the investment of their individual accounts, the plan fiduciary may wish to make available to participants an investment expert to advise and or manage their accounts, if they so elect. And given the increasingly complex nature of retirement investing and the fact that most plan participants do not have the time or expertise, or interest for that matter, to manage this on their own, many employers find this service to be an essential feature of their retirement programs. If this is done, the plan may be receiving two tiers of investment management and or advice services, one for the plan fiduciary and one for the participants. For many plan fiduciaries who are not themselves investment experts, retaining both levels of service will be important to ensure proper fund lineup selection and monitoring at the plan level, and to offer a resource to participants who need help investing their plan accounts. Some plans will make available investment education to participants instead of investment advice or management services. Investment education is information about retirement investing in general, rather than investment recommendations that are tailored to an individual participant. Under DOL guidance, such information is not considered investment advice, and therefore the provider of the education will not be considered an ERISA fiduciary based on providing that information. Investment education can include tools such as asset allocation models that are generated based on information provided by the participant. Such models must be based on generally accepted investment theories and meet several of the requirements, mostly aimed at making clear that the models are not directed at any particular individual. For example, they're not individual investment advice. The DOL has made clear that the selection of a provider of investment education is a fiduciary function. Therefore, as with any other service provider, the fiduciary will be responsible for the proper selection and oversight of an investment education provider. Next, the investment advisor manager is also an ERISA fiduciary. But whether an investment service provider is providing advice or management services, the service provider will generally be considered to be an ERISA fiduciary. The provider of advice is an ERISA fiduciary because it is providing investment advice for a fee or other compensation. The provider of management services is an ERISA fiduciary because of its authority and control over plan assets. And while these service providers are fiduciaries and therefore can themselves be held liable for their breaches of fiduciary duty, it's very important to keep in mind that under ERISA, their fiduciary status does not remove the responsibility of the fiduciary who hires them. For example, most courts have held that a fiduciary will not be insulated from liability merely by relying on the advice of experts. Therefore, relying on the investment advice of an investment expert will not necessarily relieve the fiduciary of potential liability, even though the investment expert providing the advice is also a fiduciary. The only way that a fiduciary can relieve itself of potential liability for planned investment decisions is to hire an ERISA Section 338 investment manager, and we discussed that a few moments ago. So while using outside investment expertise in any form makes liability less likely by helping the fiduciary make better decisions, and the investment expert can also be held liable for its own decisions, it's important to understand the limits of the hiring fiduciary's protection from liability when it hires investment experts. Next, there's the issue of investment diversification considerations. When selecting an investment provider, it may be important to consider whether the provider's product offerings can allow the plan's investment portfolio to be adequately diversified. This is generally more of a concern for plans in which participants direct the investment of their individual accounts. These plans often want to be able to work with a single provider to offer the plan's investment options. Therefore, the fiduciary should ensure that the provider offers access to a fund lineup that will allow a participant to diversify his or her account sufficiently to avoid large investment losses. In addition, many plan fiduciaries will want to take advantage of the fiduciary liability safe harbor found in ERISA Section 404C. ERISA Section 404C generally provides that the plan fiduciary will not be liable for losses resulting from individual and participant investment decisions so long as the participant can choose from among a broad range of investment options and certain other requirements are met. A fiduciary who wants to use this fiduciary safe harbor will want to ensure that the investment provider's product offering includes a sufficiently broad range of investment options. In general, this means that the product offering must have at least 3 investment alternatives, each with unique risk and return characteristics that in the aggregate allow the participant to create a personally appropriate investment portfolio that minimizes risk through diversification. So that is basically the plan investment nutshell portion of the presentation. We're now going to move on to the non-investment plan management and administration portion. And as I noted earlier, ERISA fiduciaries include individuals or entities who exercise discretionary authority over plan management and administration. Non-investment related plan management and administration includes functions such as maintaining a written plan document, maintaining the plan's funding vehicle via a trust or insurance contract, record keeping of plan financial activities, Form 5500, reporting to the DOL, providing certain information to plan participants, for example, the summary plan, descriptions, and benefit statements, and maintaining operational compliance with applicable legal considerations. So now we'll move on to a little bit of a discussion about hiring outside service providers under this topic. So some of the activities I just mentioned, such as record keeping, preparing Form 5500, coverage, and non-discrimination testing, do not involve the exercise of discretion or authority and are not necessarily in themselves fiduciary functions. However, determining who will perform these activities and ensuring that they are done properly are fiduciary functions which are subject to ERISA's fiduciary standards. Many of these activities require specialized professional expertise, systems, or other physical capabilities that plan fiduciaries don't have. In some cases, the plan fiduciary might be able to perform the activity but does not have the time, or is simply more cost-effective to outsource it somewhere else. And in these cases, fiduciaries must obtain service providers to assist them with these functions. In hiring service providers to perform these services, the duties of loyalty and prudence apply in the same manner as when hiring investment service providers. So, for example, the duty of loyalty would generally prohibit the hiring of a firm that the fiduciary has an ownership interest in, such that the fiduciary gains a personal financial benefit from the service relationship. Likewise, the duty of prudence involves the same procedural prudence considerations that we've already discussed a little while ago when selecting and monitoring service providers or non-investment service providers. So now we're going to talk about non-investment service provider considerations. Some examples of important plan administration activities that often require the assistance of an outside service provider will be touched on a little bit now, along with a discussion of some of the specific considerations that should be given in hiring of service providers to perform certain of these activities. So as far as plan document preparation, ERISA requires that a plan be established and maintained pursuant to a written instrument. So this means not only establishing the written document at the inception of the plan, but also reviewing it and updating it periodically to ensure continued compliance with applicable laws and consistency with plan operations. Because retirement plans are subject to so many legal requirements, these requirements are always changing. Maintaining the plan document requires substantial legal and technical expertise. And for this reason, many employers hire attorneys or consultants to help them draft and maintain their plan documents. Additionally, many service providers have developed standardized prototype plan documents that individual employers can adopt for a relatively nominal charge, thereby avoiding the expense of writing an individually designed plan document. The service provider sponsoring the standardized document then generally has the responsibility to update the document for changes in the law. So some of the important factors that we should consider in retaining a document preparer include whether an attorney or consultant or sponsor of a prototype document be used. If the plan has unusual or complex terms, it may not be possible to use a prototype document. In that case, it may make sense to retain an attorney or other expert to draft an individually designed document, even though this will generally cost more than using a prototype document. On the one hand, if the plan has simple and or commonly used terms, the less expensive prototype options may make, or the less expensive they'll be and the more sense they'll make. If an attorney is used, the fiduciary should ensure that the attorney is obviously licensed to practice law and is an expert in the necessary areas of the law. For example, ERISA and the relevant tax qualification rules of the Internal Revenue Code. Also, if a prototype is used, the fiduciary should ensure that it has a current, favorable opinion letter from the IRS and that the document provider commits to keeping that letter current by updating the document for future changes in the law. Often the person providing document services will often provide certain required participant disclosure documents that are based on the plan terms, such as the summary plan description. The same considerations for determining whether a service provider is qualified to provide document services should be applied here. And if a prototype document provider is used, it may make sense to ask to see a sample of those disclosure documents. As part of the plan's fiduciary ongoing monitoring and oversight duties, all documents should actually be reviewed for accuracy. There's also the issue of the Form 5500 audit. An ERISA covered plan is required to file an annual report on Form 5500, and the DOL filed a report with the DOL that includes detailed information about the plan and its operation. If the plan is a large plan, generally a plan with more than 100 participants, the plan is required to file audited financial statements with the Form 5500 each year, and the audit must be performed by a licensed independent qualified public accountant. Some important considerations when retaining an auditor include requiring that the auditor be licensed or certified as a public accountant by a state regulatory authority, and the fiduciary must therefore ensure that the auditor has a current license or certification. Also, ERISA requires that the auditor be independent, and that means that the auditor should not have any financial interest in the plan or the plan sponsor that will affect its ability to render an unbiased opinion about the financial condition of the plan. Also, regarding the auditor, they should have experience in auditing employee benefit plans. In particular, employee benefit plan audits require the auditor to consider factors that are unique to employee benefit plans that might not be required for audits generally. Examples of factors that auditors need to consider are the timeliness of plan contributions, whether benefit payments are made in accordance with plan terms, whether there are any issues that might affect the plan's qualified status, and whether there are any potential prohibited transactions. The need for specialized experience with employee benefit audits may justify an extra cost that may be incurred in retaining an auditor with this particular experience. Next up in terms of importance is record keeping, and the administration of a defined contribution plan such as the 401k requires that the extensive or separate accounting of financial activity in individual participant accounts. That is. So this requires the allocation and crediting of contributions and earnings, the processing of distributions and other transactions, and the reconciliation of these transactions on a daily basis. Most employers and other fiduciaries do not have the physical or systems capability to perform these particular functions. Some important consideration to be given is when retaining a record keeper includes the following items. We want to know, can the record keeper track individual account financial activity on a daily basis? So-called daily valuation is not a legal requirement, but as it is generally what plan sponsors or participants expect. Also, will the record keeper also perform certain compliance tasks necessary to the operation of a retirement plan? And will it assist with the preparation of the Form 5500? Many compliance tasks required to maintain a plan's tax favored status, such as top-heavy testing, non-discrimination testing, and testing for compliance with contribution limits, rely on the financial activity tracking functions of the record keeper. These tasks, as well as the valuation and reconciliation of plan assets and financial activity, are all necessary for the completion of the Form 5500. Therefore, the record keeping, the record keeper will often perform these functions as part of its record keeping services. If the record keeper will perform these services, the plan fiduciary must evaluate the record keeper's qualifications in these areas. Another question is, will the record keeper assist with participant enrollment in the plan? Section 401k plans and plans that provide for participant investment direction generally require participants to be able to actively enroll in the plan by making a salary deferral election and or directing the investment of their accounts among the available investment options. Since employers are generally not equipped, most employers aren't equipped anyway to perform this function, it's usually important that the record keeper or some other service provider be able to do so. And lastly, will the record keeper assist with the administrative requirements for plan distributions? While distributions from tax-qualified retirement plans must generally be preceded by a notice to the receiving participant informing him or her of the applicable distribution and rollover options and the tax consequences of those particular options. Additionally, some plans require special notices to be provided to participants who are married at the distribution. And when I mean at the distribution, at the actual time of distribution. Once distribution occurs, it's required to be reported to the participant and the Internal Revenue Service on a Form 1099-R, and if the record keeper will perform or facilitate those functions, the fiduciary will need to evaluate the record keeper's or other service providers' qualifications and capabilities. So I think we'll conclude there. We've gone through enough of the non-investment plan management administration as well as the plan investment management administration. As you can see, they're both not overly complex in terms of the rubric, but very detailed, I would say. Very detailed instructions and steps that have to be taken when being charged with or responsible for a high-level duty such as this that carries great weight from a criminal perspective and also from a career perspective. It's very important to pay close attention to the differences between plan investment management and non-investment plan management responsibilities. So I think we'll conclude there. It's been one of our longer discussions, but we will conclude there and pick up with the DOL rule in our next presentation. Thank you.